If you're 62 or older, you've probably worked hard for decades to pay off your home, or you're very close to it. But what if that equity you've built could actually work for you? Most people don't realize this, but there's a way to turn a portion of your home's value into cash without selling, without moving, and without adding a monthly mortgage payment. It's called a reverse mortgage, and for the right homeowner, it can be one of the most flexible financial tools available, especially if you want to stay in your home long term or buy a new one that fits your lifestyle better. So in this video, we're going to break down exactly what a reverse mortgage is, how it works, and what you need to know before deciding if it's right for you. You'll learn how a reverse mortgage unlocks your home's equity, what the FHA HECM program is, and how it protects homeowners who qualifies, what types of homes are eligible, and how you can even buy a new home with a reverse mortgage and never make a monthly payment. So let's dive in. A reverse mortgage is officially known as a home equity conversion mortgage, or HECM. It's a federally insured loan program designed for homeowners age 62 or older. It allows you to convert a portion of your home's equity into usable cash or monthly income while you continue living in the home you love. The biggest difference from a traditional mortgage is this: you don't make monthly principal and interest payments. Instead, the loan balance grows over time and it's repaid later when you sell the home, move out, or pass away. But here's what's important: you stay on title. The home remains yours. You keep full control. You decide when or if to sell. You can't owe more than the home's value. And reverse mortgages are non-recourse, which means if the housing market changes, neither you nor your heirs ever owe more than what the home sells for. So it's designed to offer financial freedom and peace of mind, not take away your home. For many older Americans, home equity is their biggest asset. According to HUD, homeowners 62 and older collectively hold trillions of dollars in home equity. But much of that wealth is tied up and not liquid. You can't spin your walls or your roof. So a reverse mortgage changes that by allowing you to eliminate your current mortgage payment and free up monthly income, which can go to cover medical expenses or caregiving costs without selling your home. It can also be used to supplement your retirement income or delaying tapping into Social Security. A lot of people make home improvements so that they can age comfortably in place, and purchase a new home without taking on new monthly mortgage payments is also an option. So unlike selling or refinancing, a reverse mortgage gives you flexibility and you decide how to use the funds. Most people are surprised to learn that you can buy a new home with a reverse mortgage through a program called HECM for Purchase. Here's how it works. You sell your current home, or you use savings for a down payment on your next one. Then the reverse mortgage covers the rest. No monthly payments required. That means you could downsize to a smaller home that's easier to maintain, move closer to family or medical support, relocate to a warmer climate or a community with amenities that you love. You could trade stairs for a single level floor plan that fits your lifestyle. So with HECM for Purchase, you could still own the home, stay on title, and live there as long as you meet the basic requirements, like maintaining the property and paying property taxes and homeowners insurance. It's a way to right-size your living situation without adding monthly debt, and it's one of the most underused options available to retirees today. To qualify, you must be 62 or older. In Texas and Utah, both borrowers must be 62 or older, in fact. You have to live in the home as your primary residence. You must have sufficient equity in the property, generally at least 50%, sometimes more. You must keep the home in good condition and stay current on property taxes and homeowners insurance and HOA dues if applicable. So for a HECM for Purchase, you'll need enough funds to cover the difference between the home's price and what the reverse mortgage provides. That money typically comes from selling your current home or from your current savings. There's no strict credit score requirement, but lenders will complete a financial assessment to make sure you can keep up with the properly related expenses. So it's not about perfect credit, it's about showing that the home will remain a safe, sustainable place for you to live. Not every property qualifies, but most single-family homes and condos do. Here are the basic requirements. It has to be a 1 to 4 unit home. as long as you live in one of the units. So FHA approved condos, manufactured homes that meet HUD standards, new construction that's fully complete and has a certificate of occupancy. So as long as the home meets FHA property guidelines and is your primary residence, you're typically eligible. The amount you can borrow with a reverse mortgage depends on the age of the youngest borrower or spouse, the home's appraised value or purchase price, and current interest rates. So the older you are, the higher the percentage of equity you can access. There's also FHA loan limits that cap how much value the program will consider. So rather than using a traditional loan to value ratio, the FHA uses actuarial tables to determine how much of your equity can safely be made available to you. So this ensures that your loan remains sustainable and that you'll always have a place to live even as the loan balance grows. With a reverse mortgage, you choose how to access your equity. You can take a lump sum payment at closing, monthly payments that provide steady income, a line of credit that you can draw from as needed, or a combination of these options. So each approach fits different goals. So for example, a homeowner might downsize. Maybe they want to take a lump sum to purchase a new property. Someone on a fixed income might choose monthly payments to supplement cash flow, whereas someone concerned about future expenses like healthcare might prefer a line of credit that grows over time. So the key is flexibility. You get to decide how your home equity works for you. Because reverse mortgages are FHA insured, the process includes several safeguards. So before approval, lenders review your ability to repay property taxes, insurance, and maintenance costs. This financial assessment protects you and ensures the home stays in good standing. If you don't have enough steady income or assets to cover those expenses, part of your reverse mortgage funds can be set aside to pay them automatically. That's called a life expectancy set aside, or LESA, and it's designed to help homeowners stay secure for the long run. Additionally, every borrower must complete independent HUD-approved counseling before moving forward. So this session ensures you fully understand how the loan works, what it costs, and what alternatives might be available. It's an extra layer of protection that puts homeowners first. A reverse mortgage doesn't last forever, but it's flexible when it ends. The loan becomes due when the last borrower or non-borrowing spouse moves out or passes away. The home is sold, the property is no longer your primary residence, or taxes and insurance are no longer being maintained. So when any of those things happen, there are several options. Okay, you can sell the property, so the proceeds would then pay off the reverse mortgage and any remaining equity is yours or your heirs. You could keep the home, so your heirs can refinance and pay off the balance at 95% of the appraised value, even if the balance is way higher. You could walk away. So because the loan is non-recourse, neither you nor your family owes more than the home's market value. So in every case, your estate, not your family's personal assets, handles repayment. Let's clear up some common misconceptions. Myth 1, the bank owns my home. False. You stay on title and you remain the homeowner. Myth 2, my kids won't inherit anything. Also false. Your heirs will inherit whatever equity is left after the loan is paid off. Myth 3, I could lose my home. You can't lose your home as long as you live in it, keep it in good condition, and stay current on property taxes and homeowners insurance. Myth 4, it's only for people who are struggling financially. Not true at all. Many financially secure homeowners use reverse mortgages strategically to preserve their savings, invest, or improve their cash flow in retirement. Here are a few ways homeowners use reverse mortgages. So example 1, a retired couple sells their 2-story house and buys a single-level home closer to their grandchildren using a HECM for purchase. They put down 50% and they never make another mortgage payment again. Example 2, a widow uses a reverse mortgage line of credit to cover rising medical costs without tapping into her 401k. Example number 3. A veteran with a paid off home uses a reverse mortgage to access $1,200 per month in supplemental income, letting him stay independent and comfortable. So each situation is unique, but the goal is the same: financial security and freedom without leaving home. A reverse mortgage isn't for everyone, but for many homeowners 62 and older, it is an absolute game changer. It can eliminate monthly mortgage payments, it can free up income for other needs, it provides access to cash or credit when you need it, and it can help you buy a new home that fits your lifestyle. And most importantly, it lets you stay in control of your home and your future. If you're over 62 and want to explore how a reverse mortgage or HECM for purchase could fit your goals, book a call using the link below. We'll review your situation, explain your options, and help you see whether it makes sense for you. And if you found this video helpful, subscribe for more straightforward homeownership and retirement insights so that you can make smart, confident decisions about your home and your future.